Hey everyone, welcome back to Corporate Decoder. Today, we're diving into a report where a company sold a bunch of stock, which might sound boring, but trust me, the devil's in the details, especially when we peek at who got what and how much cash changed hands. We'll try to break down the important and interesting consequences of these transactions. This report is about Cottonwood Communities and it outlines recent unregistered sales of their equity securities, specifically preferred stock. They're basically selling shares to specific investors without going through all the usual public offering hoops. This allows them to raise money quickly, but also comes with certain restrictions and implications that we'll explore. Before we continue with the breakdown, if you appreciate getting straight insights from corporate documents, make sure you're subscribed to the channel. We also have a Discord community linked in the description below if you want to join similar-minded people and talk about corporate filings. So, the company sold some equity securities without registering them. This means they didn't have to file a mountain of paperwork with the SEC, the Securities and Exchange Commission, which is a government agency that regulates the stock market. Instead, they relied on an exemption, a special exception to the usual rules. In this case, it was Rule 506. They relied on an exemption, a special exception to the usual rules. In this case, it was Rule 506 in V of Regulation D, which lets them sell to accredited investors. These are people with a lot of money or financial expertise who are considered less likely to need the full protection of a registered offering. They've been running two private offerings selling stock only to specific investors, one for Series A convertible preferred stock and another for Series 2025 preferred stock. The Series A offering kicked off in September of 2023 and the Series 2025 one started in December of 2024. They hope to raise up to $150 million. That's a lot of money in each offering. The price was set at $150 million. That's a lot of money in each offering. The price was set at $1.24. They hope to raise up to $150 million. That's a lot of money in each offering. The price was set at $1 a share for both. Sounds straightforward, right? But keep a close watch though, because the devil is in the details. During a short period from the end of June, specifically June 30 to early July 7th of 2025, they sold over 160,000 shares, more precisely 160,000 shares, more precisely 1,618.68 shares of their Series A convertible preferred stock. They then made about $1.6 million FIs into 2025. There were over 9 million shares, a lot if you think about it in terms of ownership and currency 6 to be exact. Now, let's switch over to the Series 2025 preferred stock that sold between June 18 of 2025 through July 7 of 2025. They sold roughly 150,000 shares, 51,900 to be precise, and made around $1.5 million. Again, more specifically, $1,945,000, NE $119,000. Just like the Series A stock, they had expenses. They paid about $91,000. Just like the Series A stock, they had expenses. They paid about $91,000 in commissions and about $45,000, sub 41, $5,000, $91,000, $19,000. Just like the Series A stock, they had expenses. They paid about $91,000 and $96,000 in placement fees. All this is how sales usually work. You need a third party to help and they charge a commission and about $45,000. But here's an interesting twist. The at 52 to be exact shares of Series 258 Sanji to simplify their capital structure to next stand for their old Series 2019 and 2023 preferred stock in exchange for their old Series 2019 and 2023 preferred stock. So they swapped old shares for new shares. This is frequently a strategy to simplify their capital structure to make their holdings more uniform. Of course, this deal meant more payments, about $21, $20, and $241, $517,000, 110 fee pleas of the Series 2025 preferred stock floating around. APSO worth the $17,000, 2158 came in payment fees. By the time July 7 of 2028 came around, they had more than $8,008,358 in payment fees. By the time July 7 of $2028 Taiji to simplify their capital structure. To make their Holden $8,008,000 2028 came around, they had more than $8,008,340.25 came around. Cottonwood Communities is actively raising capital through these private offerings. It's issuing a ton of shares on the market and in exchange for older shares. The amount of shares on the market is a very important measurement in terms of ownership, having accredited investors as the report states, which suggests a certain level of investor confidence in, hopefully, their strategy. However, all these commissions and fees are pretty significant. They're essentially reducing the amount of cash that actually makes it into the company's coffers. That can limit the company's growth and investment potential. Also, this exchange of old shares for new isn't just about looks or simplicity. It's also about managing their debt and obligations. It might be a strategy to avoid paying out cash dividends on those older shares, as the new shares may have different terms. And now for my take on the company. Cottonwood's strategy looks like a mixed bag. One of their strengths is probably their ability to attract investment that allows them to grow or to restructure their financing. Raising money this way is costly. It might indicate difficulty accessing more traditional, less expensive funding that may arise from public offerings. They may also lack the access to conventional loans. The commissions and fees mentioned throughout this report really add up, eating into their potential profits. One potential risk is the dependence on accredited investors. If, for whatever reason, these investors lose confidence or can't participate in future offerings, Cottonwood could face some issues raising capital. This should be seen as quite bad. An opportunity would be streamlining their operations. Cutting down on those fees and commissions could free up a significant amount of cash so they can invest it in more things that are more profitable. In conclusion, Cottonwood Communities is showing ambition to grow, but they need to balance that with some cost-saving measures and find more efficient ways to finance their operations. Alright, that's our deep dive into Cottonwood Communities' latest filing. What's your take on these numbers? Are they heading towards a growth spurt, or are these costs a red flag? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps, and subscribe for more insights into the world of corporate filings. Feel free to join our Discord server if you would like to. Thanks for watching, and I'll see you next time.